How many of you own a house or an apartment? But Google doesn't pay you enough to buy your own apartment. Right? Time to raise your salary. So I'll make sure that happens. Okay? You know how this works, right? What do? You hire a realtor. The realtor shows you a house. I'm thinking of moving to La Jolla, especially after 2 winters. Like, I'm done. 28 winters in New York. I'm out of here. My wife's from California. I'm going back. I went to UCLA. I can't take this anymore. So I talked about this with my wife, and the minute I said it, she's checking out houses. Hey, this is a thing. And she picks the most expensive part of California. Look, La Jolla. This is a slum in La Jolla. It's less than $1 million. That shows it's one of the cheapest houses probably in La Jolla. But here's my question. How did the realtor come up with that $995,000 for the house? How does a realtor come up with a number for an apartment? What does he or she do? She looks at other apartments, or he looks at other units that's sold in the neighborhood, adjusts for the fact that you have an extra bedroom or a bigger lot. It's pricing. There's no valuation going on. You're saying those unsophisticated realtors. Let me show you a second. You've seen an equity research report? If you haven't, save yourself the trouble. Because here's what the analysts will do. You'll say there'll be a company name, there'll be a multiple, which is like a standardized price, like a price per square foot, a price earnings ratio. There'll be 15 other companies that the analyst claims are just like your company. In what universe, I don't know. I've seen Google equity research reports. These 15 companies are just like Google. I look like, oh, really? It's amazing. How do you find those? I would argue that the realtor was on much firmer ground looking at apartments around the neighborhood than an equity research analyst trying to find 15 companies like Google. But that's exactly what the equity research analyst is doing, is pricing your company based on what comparable companies trade at, though there's nothing comparable about them. You're saying those unsophisticated equity research analysts. Right? You'll sometimes see a discounted, this looks like one of those discounted, if you pay a banker, this is what you get, cash flows. The next time you see a valuation from a banker, zero in on the biggest number in a discounted cash flow valuation. It's always the end number, the value at the end of year 5. Take a look at where that number comes from, and I'll wager in 9 out of 10 banking valuations, that number comes from applying a multiple to year 5 number. What do I mean by that? They'll take in this case, here's what I did. I took the operating income in year 5 and multiplied by 10. I say, why 10? Because that's what other companies trade at right now. I can tell you all kinds of stories, but this is a pricing as well. I'm just hiding it in year 5. I call these pricing in drag. The drag component is the cash flows, right? While you're distracted by the cash flows, you slip in 10 times EBIT. That's what's driving this number. Most of what passes for valuation out there is pricing. You're saying, so what? It's a very different game. The price, what sets prices? It's demand and supply, mood and momentum. What sets value? Cash flows, growth, and risk. Could the two give you different answers? Absolutely. If you're a trader, not a trader, but a trader, you care about prices. What's CNBC? CNBC is an instrument for trade. You are trading the stock. All you care about is what moves prices. So the only question I'm asking is, what's the mood, what's the momentum, where is it going? So if you ask me to explain why people are paying $41 billion for Uber, you know why? Because they think they can sell it for $75 billion. That's basically it. That they think that they can take it in a public offering for $75 billion. Are they right? If the momentum continues, they could very well be right. Does that mean that Uber has a value of $75 billion? That's a very different question. Sometimes price and value can diverge, and if they diverge, they can give you very different numbers. The social media space is a pricing space. In fact, if you ask me why social media companies trade at what they do, I have a very simple answer. It's not because of how much they made in revenues. It's not because how much money they made. Thank God for that, because most of them make no money. So here's what I did. I decided to let the data tell me what drove the pricing. And here's what I did to answer the question. I took every social media company. It's easy to get the public information, what the market value is. And then I collected all the information I could about these companies, what they had in revenues, what they had in earnings. What I was trying to figure out is, how is the market pricing these companies? What is it using to come up with the prices? And I drew on statistics to answer that. All I did was a correlation between the market cap and different variables to see which one had the highest correlation with the market. So what is it that makes some social media companies valuable and the others not? And you can look across the correlations, and by far, look at that, look at the correlation. The most critical variable in explaining the market value of a social media company is the number of users. I'll give you a very simple way to value a social media company. Here again, you could save yourself the trouble of hiring a banker. You tell me how many users you have. And if you go back to the previous page, the market's paying about $100 per user. You tell me how many users you have. I'll tell you what your value is going to be in the company. So how many users does Twitter have? 250 million. 250 million times 100 is 25 billion. We're done. Who cares about cash flows, growth, and risk? Facebook has 175 billion users. A million users. They wish they had 175 billion. What planets are you going on to, right? 175, 1.75 billion users. You multiply that by 100, you get $175 billion. And remember last year when Facebook bought WhatsApp? How many of you have WhatsApp on your phones? How many of you pay for your WhatsApp? That settles my case. Like 1 in 5 people. In fact, last year when they bought WhatsApp, they paid what, 20 billion for the company? 19 billion seems to have rounded up to 21. Don't ask me how those things happen. It's just a couple of billions anyway. I got a call again saying, how do you judge? For some reason, people think I have to explain what other people do. How do you explain what Facebook just did? And I said, you're missing the point. Facebook is not buying WhatsApp for the earnings, the cash flows, and the revenues. What are they doing? How many users did did WhatsApp have? Like 400 million. Even if you allow for the fact that about 80 or 100 million of those are already Facebook users, you're buying 300 million new users. If the market's paying $100 per user, 300 million times 100 is 30 billion. You're getting a bargain. Don't laugh. This game is going crazy right now. People are buying users because that's what the market is rewarding. You're saying, what's wrong with that? Markets are fickle. Today they like users. Tomorrow they might not. Remember, they liked website visitors for a long time till they said, you know what, I can't pay dividends with website visitors. It's kind of tough. I'll take 3 visitors, please. Send them to my house. They'll work around. I paid a lot of money for your stock. At some point, they're going to ask for substance. The way I describe social media companies, it's like having a gigantic store with nothing on the shelves and lots of foot traffic. That's what you're buying. What are you hoping for? That if you put something on the shelves, maybe they'll stop and buy it. It's not an unreal exercise. I call it a field of dreams. Remember Kevin Costner says, if we build it, he will come. It's the same thing. If we have the users, it will come. How it will come, I don't know, but it will come. But that's what pricing is about. It's not about what you and I think matters. It's what the market is building in. Which brings me to my last point. And I hate to be the one to break this. This is a game where luck is the dominant paradigm. When I say this, I'm talking about investing, venture capital investing, regular investing. We like to think it's skill and hard work. It's luck. If you're lucky, you can do horribly sloppy things and be incredibly rich. If you're not, doesn't matter how well you do things, you're still going to lose money. If you're lucky, all else is forgiven. And all too often, when people make money, they like to claim it's skill. For a while, the hedge fund managers were saying this, right? We're skillful guys. We're the smartest people in the room. Says who? I don't think there's when people talk about smart money, I always cringe. There is no smart money. There's less stupid money and more stupid money, but there's really no smart money. And in fact, the best evidence that there is no smart money in hedge funds is what's happened collectively to the hedge fund business. You know how hedge funds work, right? First they take 2% of your money up front. Then they take 20% of whatever your upside is. It's a horrendously bad setup. But you do it because you're greedy. You think they can deliver more than the market. Collectively, hedge funds deliver about 1 percentage point less than what you could make by putting your money in an S&P 500 index fund. It's a strange business. I can't think of it. The analogy would be starting a plumbing business called Floods Are Us. And here's what you do. There's a leak in your house. You call me and I leave a flood. You would never call me back, right? That's what we do collectively with these hedge funds. We pay them tons of money to do what? Earn less than what we could have made by not paying them. You figure it out, because I certainly can't.